In this lesson, we will discuss the accounting for investments and consolidated financial statements. We'll begin our discussion with passive investments. Now, an investment without significant influence over the investee is considered as a passive investment. Now, the investor is the company that purchases an investment issued by the investee. So the investor invests in the investee. Generally, debt investments and stock investments of less than 20% of shares outstanding are considered as passive investments. The categories of passive investments are trading securities, available for sale securities, and held to maturity securities. Now, trading securities are reported at their fair value in the balance sheet. The fair value is simply the market price. Now, trading securities are investments that are actively traded to take advantage of short-term changes in prices. Trading securities are reported at their fair value or market value on the balance sheet. Available for sale securities are held for longer periods. Now, they are also reported at their fair market value on the balance sheet. So we'll say that available for sale securities will be passive investments held typically by non-financial services companies, because companies in the financial industry could be holding securities and actively trading in them, and those securities will be considered as trading securities. Now, held to maturity securities are applicable to debt securities, such as bonds, which have maturity dates. Now, held to maturity securities can also be referred to as amortized cost securities, and they are reported at their amortized cost on the balance sheet. Now, in the accounting for passive investments, we tend to recognize unrealized holding gains and losses. The unrealized holding gain is an increase in the fair market value of trading or available for sale securities that are still owned by the investor company. The unrealized holding loss is a decrease in the fair market value of a trading or available for sale security that is still owned by the investor company. Now, unrealized holding gains and losses for trading securities are reported in the current year income statement. And note that these amounts from the income statement eventually flow to retained earnings. Now, unrealized holding gains and losses for available for sale securities are reported as part of a separate component of shareholders' equity called accumulated other comprehensive income. Now, recall that the accumulated other comprehensive income contains items that bypassed the income statement, and these items are referred to as other comprehensive income. And an example is the unrealized holding gains and losses for available for sale securities. Now, note that the realized gain or loss is the gain or loss realized when the securities are sold. Now, the realized gain or loss is reported in the income statement. Now, under the equity method of accounting, equity method earnings must be computed as the reported net income of the investee multiplied by the percentage of the outstanding common stock that is owned by the investor. So what this means is equity method earnings for the investor equals percentage of ownership multiplied by the net income reported by the investee. Now, dividends received from the investee are treated as a return of investment, which implies that the dividends received are subtracted from the equity method investment account. Now, let's contrast this to the fair value method for passive investments. Now, the equity method investor does not report investments at fair or market value. Equity method investments are reported at adjusted cost, and the adjusted cost is the original price plus the proportionate share of the investee company's profits or losses less dividends received. Let's now review two examples that illustrate equity method accounting. Example 1. If Company A owns 30% of the outstanding stock of Company B, significant influence is presumed and the investment must be accounted for using the equity method. If Company B reports net income of 100,000, Company A will recognize income from its investment in Company B, and the amount will be percentage ownership 30% multiplied by the net income of Company B, which is 100,000. Therefore, Company A recognizes investment income of 30,000. Example 2. Company A owns 25% of the outstanding stock of Company B. Again, significant influence is presumed, and the investment must be accounted for using the equity method accounting. If Company B declares and pays dividends of 100,000, Company A recognizes dividends of 25,000, and the 25,000 was calculated by multiplying 25% to the 100,000 dividends. Now, the investment balance should therefore be reduced by the 25,000. We will now discuss investments representing more than 50% ownership, and this is investments with control. Now, stock investment representing more than 50% of the investee company's voting stock is generally viewed as conferring control over the investee company. The investor and investee companies must be consolidated for financial reporting purposes. Consolidated financial statements portray the financial position, operating results, and cash flows of affiliated companies as a single economic unit, so that the scope of the entire company is more realistically conveyed. The consolidation process merely replaces the investment account with the actual assets and liabilities to which it relates. What this means is, in a consolidation, all intercompany items are eliminated so that the consolidated statements show only the interests of outsiders. Let's now consider the preparation of a consolidated financial statement for a wholly owned subsidiary, implying that we are looking at 100% ownership of the subsidiary company by the parent company. Note that the asset and liability accounts of the parent company and the subsidiary are combined into the consolidated financial statement. Note that the asset and liability accounts of the parent company and the subsidiary are combined in the consolidated financial statements. For example, current assets is 5,000 for the parent company and 2,000 for the subsidiary. We combine the current assets of the parent company and subsidiary company in the consolidated financial statement and we report 7,000. Note that the investment account on the balance sheet of the parent company, which is 2,000, as well as the subsidiary equity accounts, 1,500 contributed capital and retained earnings of 500, are all eliminated. And we see this in the consolidated adjustments. Investment in subsidiary is eliminated. Contributed capital and retained earnings of the subsidiary are also eliminated. Let's now consider consolidation when ownership is less than 100%. Again, the asset and liability accounts of the parent company and the subsidiary are combined into the consolidated financial statement. So for example, property, plant and equipment for the parent company is 10,000 and for the subsidiary company is 3,000. We combine the two in the consolidated financial statement to get 13,000. Again, current assets for the parent company is 5,000, for the subsidiary 2,000, and we combine the two for the consolidated financial statement and have 7,000. Note that the investment account on the balance sheet of the parent company is 1,600, reflecting 80% ownership of the subsidiary. Now, the total equity of the subsidiary is 2,000, that is 1,500 plus 500, and 80% of 2,000 is 1,600. Now, if the parent company is carrying 1,600 of the 2,000 equity, that implies there is minority ownership or non-controlling interest of 400 in the subsidiary company. Now, to consolidate, we eliminate the 1,600 investment account as well as the subsidiary's equity accounts, that is 1,500 common stock and 500 retained earnings. Both are eliminated. We then include non-controlling interest of 400 to complete the consolidation process. So again, we eliminate 1,500 and 500 being the common stock or contributed capital and retained earnings of the subsidiary. We eliminate 1,600 being the parent's investment in the subsidiary reported on the parent's balance sheet. We eliminate that. So the consolidated financial statement will have the combinations of the assets, PP&E, liabilities, and then we report the non-controlling interest. Now, I end this lesson by noting that there is a possibility that consolidation could mask the weak performances of companies. Also, the ratios calculated from consolidated statements might prove deceptive. This is because they are composites or weighted averages across possibly various business segments.